My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not to entertain, but educate and teach you. So call me at 1-800-743-CNBC. Maybe tweet me at Jim Cramer. Every rally has a life cycle. At first, it's led by the strongest companies out there. Right now, that's the Magnificent Seven. They're still at the forefront as the market staged a decent rally. Dow advancing 173 points, S&P climbing 0.46%, NASDAQ gaining 0.70%. That's ahead of tomorrow's Fed meeting. But then as the rally goes on, the strength extends to others in the same ballpark. Think semiconductors, cybersecurity, enterprise software. We then get a further broadening out of the rally away from tech. In this stupendous run, buyers converged on a curious admixture of cyclical stocks, home builders, aerospace, and the railroads.
All aboard!
As the advance continues, more left-behind groups start playing catch-up. Think heavy industries, materials, travel, and leisure. Because this rally centered on moderating interest rates, the retailers then advance as they survive on their credit and the credit of their customers. Therefore, they thrive when rates go lower. Hey, then it extends to the banks, which got crushed by the Fed's rapid-fire rate hikes. More on the banks later. Even the drug stocks have joined the parade thanks to takeovers in the GLP-1 diabetes and weight loss drugs. And then the food stocks throw off the GLP-1 shackles, and they have their day in the sun. Finally, after all this institutional hoopla, we get to where individuals, so-called retail investors, are buying stocks en masse. In this case, the most since 2022.
Buy!
And that's where we are in the life cycle right now. I have to tell you, I always hope that they go for higher quality companies when these investors come in, like the ones we know for the Travel Trust, which you can follow by joining the CNBC Investing Club. We don't speculate. That's not usually what happens. These late to the rally investors seek quick wins. They often gravitate to just pure speculation. And in a nod to the memesters of old, they seek stocks with large short positions, trying to engineer another GameStop. Yeah, that stock infamously soared from the single digits to the 400s in a few weeks' time. So the siren song of an overly shorted stock beckons, even if it is a huge money loser. At the same time, these new buyers want to own crypto. You know, I met with about 100 individuals this weekend when I signed bottles for my wife's Mezcal brand in Dallas, Texas. And while many wanted to know about our position in the Magnificent Seven, especially NVIDIA, a preponderance wanted my blessing on different cryptocurrencies or crypto-adjacent stocks. I couldn't give it to them. I never like to see this kind of speculative frenzy because of what it represents. Remember, I'm tracing the life cycle of a rally here. And rallies tend to stop once the rank speculation gets too heavy. I see that happening now. Let's go back to the fuel that's kept this rally going, the possible peak in interest rates. When the Fed meets tomorrow, if it doesn't show any sign of dovishness, if it dismisses the cooler inflation numbers like today's CPI, Consumer Price Index, you need to brace yourself for a sell-off. And the epicenter of the decline will not be the solid stocks that deserve to go higher. It'll be the most speculative stocks that have already had huge runs. What exactly am I talking about here? Let's get granular, okay? I'm going to give you some of them. I want to start with the firm holdings. That's the buy now, pay later outfit. They look like roadkill as the Fed raised interest rates. People believe the firm's borrowers would default on their short-term loans, and the company attracted a legion of short sellers who assumed the Fed would never stop tightening. But a firm is run by Max Levchin. He's a frequent guest on Mad Money, and he's got a very good handle on things. Not a lot of defaults. So the shorts, and 22% of the float is still currently shorter, appear to be on the wrong side of the trade when a firm reported a quarter with no real degradation in credit quality.
They know nothing!
The stock's now up nearly 125% since the end of October. Is that sustainable? I don't think so. But the short busters imbued with the power of panicked short sellers simply don't care. If you own a firm, guess what? I think you should take profits.
Sell.
Because it's a highly speculative stock that's highly hostage to interest rates. For me, a firm's the poster child for this late stage of the rally. A money-losing company with a risky stock that's up huge because successful short busting, and it could go down huge if the Fed says the wrong thing. Hey, then there's Coinbase. Now, people who want a stock that gives you the bang of crypto have gravitated to Coinbase with its 15% short position and its in-your-face attitude toward the SEC. The company itself, though, does not make money. The stock's up 81% since October, based on a correlation with the rally in crypto. If you buy Coinbase now, guess what? I think you're late to the party. Hey, next, let's talk about Beyond Meat, one of the bigger busts of our era. These guys seem immunized against profitability, hence the 45% short position. This one has a real GameStop feel. Left behind, thought to be on its last legs. No wonder it's up nearly 77% in less than a month and a half. What else? Okay, we recently spoke to David Risher. He's the new CEO of Lyft, which is Uber's much smaller rival. Once again, I was impressed with his vision, and I like his execution. Many people want to see a viable competitor to Uber, and I think Lyft can ultimately break even, despite its continual losses. But does the stock deserve a 52% gain since the end of October? Yes, if you think the considerable base of short sellers are still frantically covering their positions. No, if you think that process is almost done. I don't know, take pride. Look, like I said, I like it. The company's going to make money, but wow, what a run. Hey, how about Lemonade, the insurance company that says it uses artificial intelligence to figure out policies? Lemonade captivated so many younger investors in the last big speculative wave during COVID. The company's losing fortunes with a loss of $3.58 per share expected for this year. And that's why 33% of the stock's float is sold short, making it a clear GameStop-like meme target, which is how Lemonade can rally 60% since October on not much more than a hope and a vague AI kicker. Please don't forget Upstart, a company that uses AI to make loans and seems addicted to losing money. That's why the stock plunged to $11 and change in May. Oh, but now it's back up to $35, up 48% just since the end of October, without any sign of profit in sight. Upstart needs actual rate cuts if its numbers are ever going to catch up to its stock price, and I don't think that category is coming anytime soon. Hey, then there's Carvana. Many thought the digital used car dealer that struggles to make money was a dead man walking. The shorts figured that this one was flat on the canvas when the stock sank to $3 and change at the end of last year. Like GameStop, they refused to ring the register. And forgetting that bulls make money and bears make money, but hogs, well, guess what? Hogs, they get slaughtered. The stock's 46% gain since the end of October is leading a whole different group of hogs to the Oscar Mayer section of the supermarket. Please take profits. Finally, I have to consider Roku part of the speculative cohort as it's spewing losses. No plans to get profitable. That said, with all this cord cutting, people are desperate to find a way to play it. And the speculators, they've seized on Roku, which is why this stock's gone from around $60 to just over $100 since the end of October. The short position is humongous, around 10% of the float, but that's still a lot of short sellers, and they're clearly hurting. It feels like a lot of buying is short covering. When it's done, I bet the stock heads lower. Bottom line, I just gave you the anatomy of a rally. We just don't want it to be an obituary of the rally. If stocks are levitating on a combination of short squeezes and Johnny-come-lately buying, and there's not selling from the people who are being greedy right now, take it from this one-time obituary writer. The funeral parlor beckons. I want to go to Roger, Minnesota. Roger.
Hey, Jim. Appreciate being on the program. I have two stocks for you today. One of them I just don't know what the heck to do with, so I actually sold out of my position, and that's Celsius. I bought some right after their last earnings report, which was another excellent earnings report. I mean, the company's growing 100% year over year, but the stock can't move. I don't know if they need to put AI behind their ticker symbol or what.
That'd be something. Well, look, I mean, look, Celsius really kind of appeals to me because PepsiCo's got a big position in it. But there is a giant 23% short, and there are lots of people whispering about how this company's not doing that well. I don't know about that. I think if Pepsi gets in it, then it's fine. But I've got to tell you, it's the shorts versus longs in a real tug of war. And I don't like battlegrounds. We've seen the rally extend to some of the most speculative spaces in the market. It could be an indicator that the life cycle of this rally is nearing its end. On Mad Money tonight, yesterday we saw the first funding delivered from the CHIPS and Science Act. So I'm going straight to the source with Commerce Secretary Gina Raimondo to get an update on semiconductors, our relationship with China, and what to expect in the new year. Then the last couple of months have been pretty bullish for the market, with long yields beginning to come back to earth. So could this move be sustained, or should investors be prepared to handle a changing market environment? I'm going off the charts on the bond market to get a sense of where things could be headed. And what the heck happened to the IPO market in the back half of the year? I'm giving you my take on the group that seemed to have a very promising start to 2023 and then fizzled out. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.